Good to see you again today. Hope you've ordered your copies though. Okay. Last class we were talking about the ventures, that's bonds of debt acknowledgement. We were able to, establish the fact that funds can be raised through, bonds or debentures, such that the investor gets to have an agreement with the business, okay, such that that relationship exists or that agreement exists for a particular period of time, okay, based on different arrangements which can be tied to the assets of the business, okay, which can be tied to a particular period and all that. So we looked at that, and then of course, as an investor, providing funds, there's got to be a reward for the fund provided. Okay, so as a debenture holder, okay, or what we also refer to as debt holders, okay, your reward, okay, over the period that your fund is being utilized by the organization, okay, is referred to as an interest. So apparently, when you invest, you expect to have a return. Okay, so last class we looked at how to account for the debenture itself. Okay, but in this class I want to look at how to account for the interest on the debenture. Okay, so let's call it now understand that interest can be earned or paid. Interest can be what? Can be earned, or interest can be what? Paid. Now, from the perspective of the earnings, you're talking about the investor. So the investor earns the interest, okay? And then the what? The business utilizing the fund, pays the what? The interest. So we can just call this guy the investee, right? So if, for instance, your business is raising funds through the venture, you're likely paying interest, or you're going to pay interest to the investor. So the investor earns the interest. So that means there are perspectives to this interest. The interest can either be earned or what? Paid. So an accountant can be here. Of course, we have organizations investing. An accountant can also be here. So wherever you are in this band, you have to understand your perspective. So if you are an accountant, from the perspective of the investor, you're going to be capturing your interest as what? As earnings. But if you're an accountant from the perspective of the what of the investee, you're going to be calculating the interest as what? As payment or as an expense. Okay, so you have to understand what we're talking about here. So, but here now, we're looking at it from the perspective of the word investee, because last time we talked about the venture, being a method or an option of raising funds for the business. Okay, so now, how do we look at interest? Now, interest is a reward, okay, paid or earned on what? On funds, provided. So what I'm saying is that if the fund is provided, the person providing the fund earns the interest, while the person utilizing the fund pays the what? Interest. Okay? Now, you understand that there are two perspectives from the person paying the interest. Of course, you can accrue for it where you're not paying it in the accounting period. So you can accrue for the interest. So what I'm saying is that the interest is due in the period, but it has not been paid. So in that case, you have to recognize it as an expense in the period that we're reporting. At the same time, recognize as a liability in the period that we're reporting. So this is what I'm saying. So let's assume that interest due for payment, let's assume it is 10 million naira. Ordinarily, you're supposed to You are supposed to pay this interest because it is due. But if it is not paid or there was no cash available to pay at the period that we're reporting, then we accrue for it. So that means that our interest expense, okay, gets debited, and then we now have accrued interest expense gets credited. So apparently this accrued interest expense here is behaving as as a liability. Then this your interest expense is behaving as as an expense. And don't forget that your expenses, when they increase, you debit. When they decrease, okay, you credit, right? Then your liabilities, when they increase, you credit. When they decrease, you debit. So from this perspective here, you can see that your interest expense, which is an expense, is increasing here. So you're debiting, okay? And then your accrued interest here is a liability, also increasing. And what are you doing? You are crediting. So this perspective now tells us that the interest on the investment is due for payment. Okay, that's from the perspective of the business utilizing the funds now. It is due for payment, but it was not paid in the year or in the period that we are reporting. So we're going to accrue for it. So this becomes an item in the comprehensive income statement. Why this becomes an item in the statement of financial position, also called your balance sheet. That is accruing for the interest. But in case you're paying for it, okay, so let's say cash payment of of interest. So in this case now you're paying, so it means that you are not accruing. You're not accruing for it in this case. Since you're not accruing for it, it means that your interest expense still gets a debit because it's an expense. It is increasing. But in this case, you're not accruing. You're paying it out. So that means you're paying out of your bank. Your bank gets credit. So in this case, now your bank here is an asset. When you make money out of your bank, your asset reduces, right? Don't forget that your asset, when they increase, you debit. When they decrease, you credit. So in this case now, your bank here is is an asset, and it is decreasing. So it takes the credit. Your interest expense is still an expense, it's increasing, so it takes the debit here. Okay? So typically what I am saying here is that you can have, two scenarios. Of course, from the perspective of the investee or the person utilizing the fund, it's possible that the interest is due, but it is not being paid in the accounting period. So in that case, you accrue for it. And it's also possible that interest is due and it is paid. So in that case, it affects your cash position, and then increase your expense as usual. And then don't forget that because it's an interest, there is the tax element, the withholding tax element. We already explained that withholding tax, of course, an advanced tax, okay, which means that the person that is suffering it, okay, is technically paying his tax in advance. So in that case, what it means is that, okay, he will utilize the money that he has suffered from his earnings to reduce his own tax liabilities. So it means that when we are paying or accounting for interest, we must also make provision for the withholding tax elements. Remember, withholding tax on interest is 10%, both on individuals and on companies. And I've already told you that for companies, you take it to Federal Revenue Service. For individuals, you take it to the State Revenue Service, so they can utilize it to reduce their income tax liabilities. So what I'm saying here is that on the aspect of payment, of course, here if you are accruing this accrued interest expense, of course you're going to split the money into two. Now look at this 10 million. Here it's going to be 10 million. Here it's supposed to be it will be what? 10 million if you're paying. But now remember that this guy here, okay, this guy here is an expense, but this guy here, the 10 million naira is not going to this person you are paying directly. You're going to have to reduce it by 10%. Okay, so that means that if you reduce it by 10%, you're going to have 1 million. So apparently 9 million will go to to the debenture holder or whoever is earning the interest, right? The interest earner, let's use that word. And then 1 million will go to the revenue service. So either Federal Revenue Service or State Revenue, depending on if it's an individual one or that is invested. So technically it's still 10 million, but you're going to remit 1 million to the revenue service, and then you're going to pay the guy 9 million. So this guy will now utilize the 1 million to reduce his his income tax with the appropriate revenue service. So in this scenario here too, of course here will be 10 million, but then the accrued expense is going to be into two. You're going to have the interest accrued, which is 9 million. Then you're going to have withholding tax on interest, which is 1 million. Okay, so they are both liabilities, just that one is due to the revenue service, the other is due to the investor. All right, now from a tax perspective, remember that interest, which is also cost of fund, is an allowable expense. Okay, so of course, sometimes professionals want to take advantage of those loopholes to reduce their tax liability. So there's the thing called thin capitalization. So you have to read up on that. You should read up on on thin capitalization. Okay, it explains okay, the aspect where organizations try to take advantage of the interest paid or of cost of funds, okay, which is also an expense anyway used for the business, okay, to reduce their tax liability. So for revenue drive for the appropriate revenue services, they will have to ensure that no one is taking advantage of these allowable expenses, okay, to reduce their tax liability. So that area that covers such issues surrounding utilizing interest expenses to reduce tax liabilities, of course, is what we refer to as thin capitalization. Okay, it's just a simple way of explaining that. So you can read that up on your own. Everything has its application and its and its effects. Talking about eroding profits and all that. So we are not discussing thin capitalization, but I'm just trying to get your attention to that. Okay, so if you have the time, you can read up on thin capitalization, explaining the steps taken by the appropriate revenue services to reduce the possibility of utilizing cost of funds or interest expenses, okay, to reduce tax liabilities. Okay, but here I've already tried to explain to you how to account for interest expenses from the perspective of the investee. Okay, so if you are accounting from the perspective of the investor, you have to understand that it is more like an income. It's earnings to them. Okay, but from the perspective of the investee, which is the person that is utilizing the fund, it is an expense. Okay, and that will be accounted for either as an accrual or as cash payment. Don't forget, we also took advantage, sorry, we also recognized, the withholding tax element on the what? Interest. So to individuals and to companies, it is still what? 10%. And the one deducted from individuals goes to the State Revenue Service. The one deducted from what? Companies or organizations limited goes to where the Federal Inland what? Revenue Service. So this is a summary of what the accounting aspect for what? Interest payment. Okay. Okay. If you have questions, you can reach my number displayed. Let's reply with the right answers. Quickly look at this very straightforward question, so we have an idea of what we're talking about. So we have the following data balance has been extracted from the books of Judah Mega PLC for the end date at the 1st of 2019. We have sales, non-current asset, cost of sales, admin and selling expenses, debtors, cash at bank. Okay, we have vendors. Then we have 10% debenture. Then we have 100 million ordinary share capital at £1 each. Then we have this additional information there. So the interest on the debenture for the period is due but yet to be what? Paid. Then we have prepaid expense amounted to what? 2 million naira. Then the business receipt non-current asset at 10% per annum. This is a very straightforward question. Let's quickly. You're required to prepare income for the end of 2019. Statement of financial position. Okay. So this is very straightforward one. Okay, so let's see. Okay, so let's see income statement for the year ended at the 1st December 2019. Okay, so we have our notes here. So the first one that we have turnover, which is note what? 1. Okay. So what we have there? What's there? Of course, at this level, you should know items that make up your sales, your turnover rather. So we have note 1. Sales. What do we have there? 450 million. So we have 450. Any other item there? None. So we have 450. The next one we have cost of what? Sales. Note 2. So we have our note 2 here. Cost of what? Sales. So what are the items there? We have 280,000. It's given to us directly. So we have 280. So this is 280. If you take that out, what do you have? 0, 0, 0, 0. 15 minus 8, then that's 7. 3 minus 2, that's 1. So this is your gross profit. So total expense now. We have note 3. So this is note 3. Excuse me. So what's the note 3 there? Admin and selling expense. So we have note 3. We have admin and selling expense. What do we have there? 45. Then some information there. I can see that there is prepaid expense. Of course, when you remember our prepaid expense, what it means is that the expense is not due for payment or we have paid in advance. So that reduces your expense, increases your what? Your current assets. At this level, you should know what I'm talking about. So you should read up on prepayments. We have it on Jarvis Consulting. So we have prepaid expense as 2 million. So now we have 2 million. So that will reduce the expenses and that will increase your current assets. So what's the next item that we have? Depreciation. We don't know that interest on the venture for the period. Look at depreciation that's reducing the cost of what? Operating assets. So we have of non-current asset. We have interest on the venture for the period. Okay, so let's call that IOD. All right. So what do we do here? Interest on the venture. What do we have? 10% debenture. So that's 10% of what? 75 million. So this. That's 7,500. Okay. Of course, this is 7.5 million as the interest on the venture. Of course, where it is paid, you would have to credit card. But if it's not paid, you accrue for it. But in this case, it is due but not yet paid. So that means we accrue for it. Okay. Then we have depreciation. So non-current asset there, say it's 10% depreciation. Non-current asset is 200 million. So that will be 10,100 times 200 million. So we have this 20,000. Okay, is there any other thing there? So we're good to go. Very straightforward question. So what do we have here? 45,000 minus 2,000 plus 7,500 plus 20,000, 7,500. So we have 7,500. So here we have 7,500. So what do we have? Okay. This is 99,500. So this is profit for the what? Year. Of course, you can go ahead to what? Compute earnings per share. You can disclose your tax for the period, if there was any dividend that is declared, you can disclose it. You get. So you can do all that on your own. Basically, I think there's a class on all that already. So just check those out. So here we have the profit for the year. Of course, that'll go to your reserve, right? So what's the next thing we should do there? Let's us show what now? Statement of financial position. So that the 1st December 2019. So we have our notes here. And we have our embarrassing here. So this is what? Assets. So we can call it. We have non-current. So let's call it note what? 4. Right? So let's go. We have note 4 here. So what are the non-current assets? The question says 200 million. So we'll take out our what? Depreciation. What do you have? 20,000. So when this goes out, that will be 180. So this is your what's carrying amount of the what? Non-current asset. So we have 180 million. Okay. So the next one here will be your what? Current assets. So we call that note 5. So let's have our note 5 here. So what are the current asset items now? Debtors. We have what's our debtors there? 50 million. What's the next one? Cash at bank. So let's just call that bank. What's that? 60 million. Okay. Remember we have prepaid expense here. 2 million. Any other item? No other item. So let's add up. This is 0, 0, 0, 2. This is 11. That's 1 around what? 12. 1, 1, 2. So we add up 0, 0, 0. This will be 2. This is 9, 2, 190 million. 192 million. So this is represented by what? Liabilities. So let's have our what? Short-term liabilities. Let's call that note 6. So we have note 6. So what are the short-term liabilities there? Okay, we have what? Vendors. So we have our vendors. What's the vendors there? 10 million. Now remember, the interest on the debenture, like I said, can be accrued for or paid for. But here, it was accrued for. So that means that it's not paid in the year that we're reporting. So we have to accrue for it. Of course, since it's an interest, we're already indebted to the what? Investors there. So we have interest on what? Debenture. So this is 7,500. But remember, that is a withholding tax element of 10%, right? So the investors are going to take 90%, the tax authority will take 10%. Then the investor will go and utilize it, to reduce their tax liability. I already explained that. You cannot take your class on withholding tax. So this is 7,500 times 0.1750. Okay. So here we have 6,750. All right, 6,750 payable to the investors. Then we have withholding tax, okay, on interest. That will be 750, which is 10% of 75, right? So what's the next one there? You know that's in there? No. So let's add. So this will be, I think it will be 17,500. Okay. So we have 17,500. So the next one, we have long-term liabilities, which is note 7 there. So we have our note 7. So what do we have there? I think that's debentures. That's 10% debenture. I think that's 75 million, right? That's about it. Let's check, confirm. Yeah. We have this. So we have our reserve now. Let's call that note 8. So we have note 8. That'll be profit for the year. Remember, if it's not equated to reserve, right? So what do you have? 99,500. 99,500. So that'll be 99,500. So what's the next thing now? Share capital. So what's our share capital? What are they? 100 million. That's 100,000. So So let's add up. See, we have 17,500 plus 75 plus 99,500 plus 100,000. 292. So you can see our total liabilities is the same thing. Your total what? So this is a very straightforward class to help us understand accounting for interests, and then also taking into consideration what do I call it now, the withholding tax element on the interest. And don't forget, like I said, that you should on your own display your earnings per share. You can also check out the current tax rate, but don't forget that the Finance Act helped us to adjust the tax rates. So if you're doing over 100 million now, I think it's 30%, right? So if you're doing between 25 to 100 million, I think it's 20%. If you're doing less than 25 million, you're not paying tax, you're exempted. So that's the Finance Act, basically, if you remember. So you can as well look at that to update your knowledge. So you can do all that here just to have a little bit of more exposure. So if you have questions, you can read my numbers displayed. I'm there to reply with the right answers. Thank you.